doing the best we can. We're doing the best we can with the new technology that is available to us to do live broadcasts through Zoom, on Facebook, recording everything and being able to share screen with you guys at the same time. So my apologies for the stutter step at the beginning. Welcome to another 30-minute Thursday. My name is Amit. It is 2 p.m.-ish in the wintry Pacific Northwest, and I am wishing you all a very wonderful day. I hope everyone's staying safe. I hope everybody's staying healthy. I hope everybody's staying sane. For you football fans out there, yes, I am wearing my Seahawk blue t-shirt. We have Blue Friday here in the Pacific Northwest. It's not Friday, obviously, but we got a big playoff game coming up, and I am a fan. I'm a fan of the game. I learned English watching football when we moved here from Israel, and so I like to support the home team. I apologize for any wonkiness with my camera angles and stuff like that. This is a work in progress, and we're doing it live, unscripted. So, guys, it's gonna be okay, but it's not gonna be flawless. It's like I tell my self-defense students, it's not going to be scripted like you see it on TV when you can edit and cut and do all these other things. But anyway, I hope everyone's doing great. Welcome to another 30-minute Thursday. I'm going to jump right in and share with you guys what's going on with the economy, what's going on with mortgage and real estate. Of course, interest has a huge game or a huge play in this. So what I want to do real quick, if I can find the way to do it, is share my screen. Stand by here. Let's see. Aha, here we go. Check it out. Okay, look at this. I'm feeling really confident with my tech skills. Two steps up and one step back, as the saying goes. But here is the way inflation works. And I'm bringing this up today because earlier today, we had a release of the Consumer Price Index, the CPI numbers for December of 2022. And I want to point this out to you guys so that you understand how things work when we talk about inflation and how we calculate what's known as the year-over-year inflation, or YOY, year over year. And this is really important as part of the entire picture of not just what's going on with the economy, but as a result of inflation, what's also happening with interest rates, what's happening with the housing market, so on and so forth. So this is a really big deal. The good news is that the year-over-year core consumer price index came in as expected at 5.8%. What does all that mean? What is core inflation, and how does it distinguish? I apologize, guys. I'm trying to find proper lighting here as well. But the core consumer price index takes out of the equation very volatile sorts of things like food prices and energy prices. And I used to joke about that and say, they may remove food and energy from the calculation, but the fact of the matter is that we all need food and energy, regardless of how the Federal Reserve Board and the government statisticians calculate the rate of inflation. And yes, that's 100% correct. And because of that, that's why they remove it, because no matter what they do at the Federal Reserve Board, no matter what they do with interest rates, no matter what happens in the economy, in general, we all need to eat, and we all need fuel for our homes, for our cars, for our heating, for everything else. And so as a result of that, they can strip out what they refer to as the volatile food and energy print on the core inflation numbers and still, calculate something realistic. And again, nothing that the Fed does is going to impact food and energy. They could raise rates, they could lower rates, they could do any number of other things, but the idea that we're going to somehow stop eating because it's too expensive, that's just not realistic. And again, Federal Reserve Board policies with interest rates going up or interest rates going down have no impact whatsoever on weather events. And the weather has a real impact on what happens with regard to food production, as an example. So they move these things off the ledger and they just look at things that they feel, they being the Federal Reserve Board and the government statisticians, they look at things they think they can utilize or that they can control and that they can calculate in a more kind of moderate sort of way. And so this is what core consumer price index is all about. And this is a very telling measure of inflation. Now, what happens is there's a monthly reading, and the reading for the month comes out usually the month after the month that passed. So what that means really is the December reading for, or the reading for December of 2022 came out in January. It just came out today. Okay, so if you look at these, for example, this is December of 2021. So a year and a month ago, December of 2021, right? Now we've got December of 2022, and that reading is going to be here. I think about it like a roller coaster. Think about it like a roller coaster, right? You've got the most recent month, you've got the last month, right? And there's all these months in between. So what happens is when December 2022 number comes out here on the far right of the graph, what happens is that the number for December of 2021 goes away. And then they add, they being the statisticians and the government folks, they add January, February, March, April, May, so on and so forth. They add all those 12 months and include the most recent month, which is December of 2022. And that's how they come up with the year-over-year rate of inflation. So as the new month gets added on, the most recent, or the last month, the caboose of the train, so to speak, falls off. That's how they calculate the year-over-year inflation. Now, why is that important? Because if you look at these numbers here, check out December of 2021. The month of December 2021, we had a 0.6% monthly inflation reading. That is a pretty big number, especially when you consider the months in the summer. We had 0.3 in July, 0.2 in August, 0.3 in September, and then it shot up in October, 0.6, and so forth. This is a pretty big number, 0.6%. It's pretty much one of the biggest numbers on this actual chart. And as a result of that, this number, 0.6, went away. And what came on top over here at the front of the train for December of 22 was 0.4%. And so when you add up January, February, March, April, May, etc., and you include December of 2022, the core rate year-over-year of inflation went from 6.0% down to 5.8%. And that is how they do the math. I mean, honestly, that's how it works. So this is a good number. It would have been better if the number was 5.6%, but 5.8% is in line with what the markets were expecting. And because it was in line and there was no negative surprise, we're looking at a pretty healthy sort of market reaction to that. And that's very, very exciting. That's really exciting for all of us because we're seeing the rate of inflation start to come down and interest rates are starting to follow suit. What I've been telling you guys for the longest time, and I'll continue telling you because not everyone watches all the time, I get it, and not everybody, it doesn't kind of penetrate and sink in the first time you hear it or even the third time you hear it. But what happens with mortgage interest rates is the higher the rate of inflation, the higher the mortgage interest rates are rising. The opposite is also true. So as inflation comes down, we are expecting mortgage interest rates to come down. The reason for this, very simply put, is when you get, as an investor, when you have a mortgage, not as a homeowner, but as an investor, as somebody that owns that IOU and that receives your interest payments. You own a home, you make your mortgage payments. I own the loan. I bought the IOU. Every time I receive your monthly payment, I get a certain amount of interest in that payment. And I use that interest to buy my food, or to buy my computer, or to buy my food's not the right example, because I just told you that we strip food out. But I use that to buy my computer. I use that to buy my hotel rooms. I use that to buy my clothes. I use that to buy whatever. When the rate of inflation goes up and up and up, and the cost of everything goes up and up and up, my ability to buy the same amount of goods and services with your fixed interest payment every month, my ability to keep buying things in the style that I've grown accustomed to diminishes, because my return on my investment, while I'm still getting the same amount of money from you every month, the buying power of that isn't as significant. It's like the older folks say, you know, back in my day, we could buy a movie ticket for a nickel. Okay, well, now you can't. Now it costs what, 10 bucks, 12 bucks, 20 bucks, whatever it is. Well, that's inflation. That's the cost of things going up over the years and years and years. So as inflation goes up, the interest rates that investors that buy mortgages also has to go up, so that the interest that these investments pay off keeps up with the rising cost of goods and services. And so these investors are able to actually use that money for their financial lifestyle. So that's why inflation is so very important. And that's why as inflation comes down, what's going to happen is long-term mortgage interest rates will also come down. And there's a lot of reasons for that. I won't bore you with all the details, but think about it this way. At some point, there's going to be a competition for these investments. And like my clients, everyone wants the lowest possible rate out there. Well, the investors also want the best possible loans out there. And so they're going to, once we round the corner on this inflation, the investors are going to say, you know what? Yes, last year we needed the interest rate in the mid sixes, but now inflation is curtailed. We have spending power from these investments at 5.5%. So we can offer to buy those loans from you guys, people like me that create these loans, at 5.5% or 5 3/4 or 4 5/8 or whatever the rate becomes. So as the rate of inflation, as this begins to even out and actually shows lower and lower year over year inflation, interest rates will come down as well. So we're in the right direction. Things are moving. Now, what's going to happen? And let me give you a preview. I want y'all to take a look at May 10th, 2023. So that's in what, 4 months. That's a little bit away, but I want you guys to circle that calendar, because in May 10th, we're going to receive the year over year number for April of 2022. Now, if you look, I'm sorry, for April of 2023. And what's going to happen is we're going to eliminate the number for April of 2022. So this 0.6% goes away. It will be replaced by a number that we hope will be lower, like 0.3% or 0.2% or something like that. And guess what? When that happens, the year over year cumulative rate of inflation is going to come down. And that is going to be very positive on the markets, meaning that the interest rates on mortgages should be coming down significantly in May and in June and in July. Remember, this is a month back. So in July of 2023, we're going to be replacing the June 2022 number. And that is going to be a big number being replaced by a smaller number as well, we hope. And as that happens, we'll add up all these other numbers, 12 months total, we'll get the year over year inflation. But as it continues to come down, we expect the mortgage interest rates will come down as well. So this chart, I keep coming back to this because it helps to see it visually, it helps to understand it graphically, and it helps to kind of visualize where we are, how it works, as they say in politics, how they make the sausage, right? Like this is how the rate of inflation is calculated at the top line. Now, there's a lot of calculations that feed into these numbers, and I'm not going to bore you with all those details, like how they calculate the cost of medical care or the cost of rent or the cost of entertainment or all that. That's what goes into, those are the components that go into these monthly numbers and ultimately into this annual number. But things are starting to move in the right direction. And that's exciting because as that happens, more and more buyers are going to come out of the woodworks. They're going to come out of hibernation and they're going to want to start buying homes. And I'm going to tell you guys, real estate partners especially, I've been saying this and I continue to say this, and I want y'all to hear me because this is really significant. So I'm going to stop sharing for a moment here. Look at that. I'm almost high tech. Let's not exaggerate. I'm medium tech. All right, I'm good with that. Anyway, here's the deal. Seriously, real estate partners and anyone who's interested in buying a home, as the rate of inflation comes down, as interest rates follow suit and come down, there are going to be a bunch of buyers that are going to come out of the woodworks. And it's going to be, I don't know that it's going to be like it was in 2020 and 2021. Those were pretty crazy months, right? I mean, pretty active markets. We had a lot of competition. I remember I was crying about this, crying crocodile tears, but I was lamenting the fact that I could write 10 pre-approval letters in a week. And on any given day, only 2 of my clients, if they were lucky, out of 10, so 20% would actually prevail in the multiple offer situations and then the escalation clause situations that we had back then. I don't know if y'all remember that. I certainly remember those days, and they were crazy in a different way, right? There was a lot of buyers, not a lot of inventory, and we wrote offers well above the asking price, right? I remember 10% above asking, 20% above asking. So if you had a home that you were selling for $1 million, there were buyers out there saying, I'll give you $1.2 million for it. That's what a 20% above asking price looks like. And there are plenty of people doing that. And there are plenty of people crying about the fact that they couldn't do that in order to win the home that they wanted to buy. That was the past. Right now, we've got a slightly different market, a very different market. But guess what? It's not going to last forever. That rate of inflation that I was showing you, that is actually coming down. And as it comes down, interest rates come down. And as interest rates come down, the buyers are going to come out of hibernation. There are tons of buyers out there. The problem is, or the delay has been, that they've wanted to see what goes with interest rates, what's going on with their employment, what's going on with everyone thinks about, maybe there's going to be a recession, what's going to happen with my job, what's going to happen with the stock market. But, excuse me, anecdotally speaking, I can tell you from just my own conversations with clients, there are more and more and more buyers coming out of the woodworks, coming back into this market, and thinking about purchasing in the coming months. And as that happens, guess what? There's going to be more competition because our supply has not increased. The amount of homes that we have for sale in the Pacific Northwest is not huge, and it's not growing. There's not a ton of new construction anyway, and there's not a lot of people reselling their homes right now. So there's going to be more buyers. There's going to be equal or less inventory. Guess what? We're going to have more crazy times. We're going to see, again, competing offers, escalation clauses, no inspections, offering above asking price. All those things are going to come back. I don't know if it's going to come back as great as it did in 2021 when it was really at that peak insanity, as people used to refer to it, but it's going to be more insane than it is right now. Right now, today, is a great opportunity for you guys to get a smoking hot deal. What does a smoking hot deal in the world of real estate look like? Without naming names, without giving addresses or anything like that, let me give you a few examples from my own client pipeline, just so that you guys understand what I'm talking about, what's out there and what's available. I have a client right now. She's signing her closing paperwork today. She's going to be a homeowner tomorrow, God willing. But she's buying a home. The asking price was $745,000. She is giving them the full asking price. That's the negotiation. $745,000. That's what she's going to pay. But she's getting $20,000 in credit toward her closing costs, her prepaid taxes and insurance, or in this particular case, she's going to do a buy down, a 3-2-1 buy down. So although her interest rate in general is in the mid 6s, for the first year of her home ownership, her payments are going to be calculated on an interest rate in the mid 3% range. That's right. 3 point something. I won't give you the entire interest rate, but it starts with a 3. Those days are long gone in general. But with the 3, 2, 1 buy down, she's going to have, for the first year of home ownership, an interest rate that starts with a 3. For the second year of home ownership, it's going to be an interest rate that starts with a 2. And then on the third year, it's going to start, I'm sorry, I take that back. I did it backwards. For the first year of home ownership, she's going to have an interest rate that starts with a 3. For the second year, it's going to start with a 4. Still incredible interest rates. If I offered that to you today, you'd be beating my door down to get those rates locked in. Sometime between the first year and the second year, we're going to refinance this mortgage, and it's going to come down on a more permanent level. But for right now, she's using the seller's money to buy down her interest rate temporarily. And that is a smoking hot deal. She's going to save hundreds of dollars, if not thousands of dollars, on her monthly payments for the first 12 months. That is significant. That's a great deal. Okay, let me give you another example. I got clients that went into contract late last night, just recent, fresh deal. They were negotiating. They're going back and forth on the purchase price and so on and so forth. They ended up doing a purchase for $860,000. So the seller was asking for more. They were able to negotiate a lower price to start with, but they also, on top of a lower purchase price, were able to negotiate $20,000 in credits towards closing costs and prepaids. Now, these particular clients are going to spend most of that money on their closing costs and their prepaids. They're going to do a smaller buy down because they would much rather keep more cash in the bank for furniture and moving expenses and things of that nature. But still, $20,000 towards their closing costs and prepaids. That's money that they don't have to spend out of pocket when we close their transaction next month. Huge deal. A year ago, if you asked for prepaid closing cost credits, seller paid anything, they would have laughed you out of it. They would have just mocked you all the way down the street. They would be telling stories about you in the office. Like, I can't believe that guy had the gall to ask for a seller paid anything. That's last year. This is this year. I've got one more example for you. I got clients right now who are writing an offer, and they're asking for 6% credit from the sellers. That's the maximum allowable in this situation. A credit of 6% is $39,000. The purchase price is in the mid 600, 650. They're asking for $39,000 in credits for interest rate buy downs, for closing cost credits, for all sorts of things. Now, this is a negotiation. I don't know if the sellers are going to give them that much money, or if the sellers are going to give them half that much money, or where this thing's going to end up. But guess what? They're having a conversation about that. The house has been on the market for a while. The sellers are ready to sell. The buyers want to buy. This is an opportunity to make a deal. When I say the house has been on the market for a while, several weeks, many weeks. And so the sellers are open. Now they're going to offer the full price, but they're going to say, hey, we want a credit to go toward our closing costs or prepaids, maybe buy down the interest rate, so on and so forth. So I don't know if that's going to work out or not. As soon as I finish my live with you guys, I'm going to check in with them and see how their offer is going and how the negotiation is going. But these deals are happening today, right now. 6 months from now, a year from now, 12 months from now, 14 months from now, whenever it is, that's off the table, guys. I mean, I don't want to scare you or anything like that. We'll always find a way to make deals happen. But in the coming months, inflation is going to come down. Mortgage interest rates are going to come down. Buyer interest is going to perk right back up again. And now you're going to be competing with everybody who's been sitting on the sidelines, hibernating, waiting for the right time. I'm telling you right now, the right time is right now. There's an old adage in the Chinese lore. The best time to plant a tree was 20 years ago. The second best time is today. Right now is a great time in this market. And all the indications that we're looking at show that mortgage interest rates are coming down. I know because I deal with this day in, day out. The rate of inflation is coming down. The economy is stabilizing. It's not going to be a straight line down. These things are kind of jagged and wavy. It might go up a little bit, come down, come up a little bit, come down. But in general, the trend is favorable. It is moving in our direction. And so rather than compete with everybody else, come into the market now, buy the home now, get a good deal, get a seller paid 3-2-1 or 2-1 or 1 year temporary buy down, get some credits toward your closing cost and prepaids, keep that money in the bank, use it for furniture or moving expenses, get yourself a home inspection and ask the seller to actually make repairs. That wasn't happening last year either. People were buying it as is, where is, no inspection, no repairs. Now you got an opportunity to see what you're buying, to do an inspection, to ask for concessions or to ask for repairs. That's a great thing when you're buying a home. It's a great opportunity right now. And I know that people have been beat up. I know that people, the media is talking about housing slump and this and that and recession. I get it. I really do. But if you're even remotely thinking that you need to buy a new home, now is a great time to do that. So I encourage you to give me a call. I'm not in the New American Funding Studios today. I'm broadcasting from home. Yes, that's our pet giraffe in the background there. So I don't have my contact information on the screen, but you guys know where to find me. If you're seeing me on Facebook, then you know where to find me. Please don't be shy. Let's talk about your situation. Let's talk about what we can do for you guys, and let's beat the crowd. There's a form of investing, a form of looking at things called contrarian. So when the entire herd is running toward the cliff, the one that's running the other direction is looked at as the crazy one. But the reality is, to be contrarian to the market trends is oftentimes the best way to find the best opportunities. And those opportunities are happening right here, right now. I hope that makes sense. I hope my examples kind of give you an idea of what's possible out there and what we can negotiate on your behalf and with your referral partners and with your clients. And I hope that you guys take this opportunity to give me a call, and let's get in there before everybody else does. Having said all that, we're again at our 30-minute mark. It's amazing how quickly 30 minutes goes. I know we lost a minute or two here or there due to technical difficulties. I expect that there will be more technical difficulties along the way, but we're learning. And I hope that you guys were able to see this video. I hope you guys were able to see the chart that I'm sharing with you guys. And I hope that you come back next week. I will share more information with you. We'll look at other things. And between now and then, if you have questions, specific questions about the market, about the economy, about mortgages, about investment homes, anything at all, please find me, ask me. I will address it either in private, just between us, or on my next Facebook Live. If you've got clients, of course, that are interested in writing offers and exploring opportunities, please, please, please reach me. And until then, first things first, go Seahawks. Yes, they're playing a big playoff game against a very heated rivalry in San Francisco. And so I do support the home team, and we got to cheer for the Seahawks. Hope that it's a good game. Hope that we prevail and that we win. And until we see you next time, next week, stay safe, stay healthy, stay sane. And thank you so much for spending a little bit of time with us today. Have a great afternoon and a wonderful weekend. Take care.